How does compounding interest affect your long-term mortgage wealth? Imagine planting a tree and watching it grow over many years. The longer you wait, the bigger it gets, especially if it keeps growing on its own. That's similar to how compounding interest works on a mortgage. It's not just about paying interest on the original loan amount, but also on the interest that builds up over time. This means that if you don't pay extra or manage your loan well, the interest can grow faster than you think. When you take out a mortgage for a home, the interest you pay can add up significantly over many years. If your mortgage interest compounds monthly, the interest is calculated every month on the remaining balance. That means each month, a little more interest is added on top of what you owed before. Over time, this can make your total payments much higher than the original loan amount. For example, on a $100,000 mortgage with a 5% interest rate, the total interest paid over 30 years can be hundreds of thousands of dollars if you only make minimum payments. But here's the good news. If you understand how compounding works, you can use it to your advantage. Making extra payments toward your mortgage reduces the principal faster. When the principal decreases, the interest that compounds also drops. This means you pay less interest overall and pay off your mortgage sooner. Using an interest offset account is another smart move. If you keep savings in this account linked to your mortgage, it reduces the amount on which interest is calculated each day. That lowers your interest charges and shortens your loan term. Choosing a mortgage with a lower interest rate or less frequent compounding periods can also help. For example, a mortgage with annual compounding will grow interest more slowly than one with monthly compounding. If interest rates drop, refinancing to a lower rate mortgage can cut your interest costs and help you build wealth faster. For real estate investors, the impact of compounding interest is even more important. If your property appreciates faster than the interest on your mortgage, your investment grows. But if the interest costs are high and grow quickly, they can eat into your profits and cash flow. The length of your mortgage matters too. The longer the term, the more interest will compound over time. Early payments mostly go toward interest, not principal. As you pay down the loan, interest charges decrease. Making consistent extra payments can make a big difference in building your equity and wealth over the long run. In the end, understanding how compounding interest works helps you make smarter decisions. By paying extra, choosing the right mortgage, or refinancing when rates are lower, you can reduce the total interest paid. This means more of your money goes toward building your wealth and less toward paying interest. Managing compounding interest wisely can turn your mortgage from a cost into a tool for growing your long-term wealth.